When a company wants to buy another one, you have to figure out what it's worth and whether the deal even makes sense. The very first step to this is crucial: selecting the right financial model. In this video, I'm building a full financial model from scratch for a hypothetical acquisition I'm calling Project Iced Tea, Nestlé buying Danone. Starting with working out which financial models you need, because a deal this size, one analysis is never enough. I'm Nico, and I've spent close to 5 years in UBS large cap M&A, where I executed over 20 billion worth of deals, but also developed the intern training program that they still use today. And I've taught investment banking interview prep at University of St. Gallen and Bocconi. And all I do on this channel is share what's working for the candidates I coach. The same thing I do every day at Neverbank: one-on-one coaching, weekly group calls, and building a community of future investment bankers. The link's in the description for anyone who's interested in learning more, and the Excel file for today's build is in there too. Let's map it out. So for a mega acquisition like Nestlé buying Danone, one single tab model will never be enough. So you can see here, this is the full model that we'll be building. I've already went through the control and cover page in the previous video, so check that out if you haven't. But what other sheets do we need within this Excel to come up with a comprehensive analysis to understand if this deal makes sense or not? On the one hand, we need input tabs to basically spread the financials, the historicals of the buyer and the target. We also need forward-looking consensus estimates to understand what do brokers, equity research analysts say about the company. Those are the experts and they understand that market and come up with projections. We need an operating model which feeds into the rest of the financial models and analyses, which is nothing else than projecting out the income statement, the balance sheet, and the cash flow statement all the way into the future, as we will need for the next analysis. Trading and transaction comparables, here we're coming into the valuation part of things. So this is to understand on a market basis what is the target company worth, to come up at least with one point of reference what one might pay for a company like Danone. He will be setting up a trading comps and transaction comps sheet and really diving into the nuances of those. Another way to come up with a value for Danone is using a discounted cash flow analysis. This is the intrinsic way of valuing a company using the projected free cash flows. Another final way we'll be looking at to get a value for the company is the leveraged buyout analysis. And this is especially relevant for financial sponsors. And what we're basically doing is back solving how much is a financial sponsor able to pay. That's why it's also called an ability to pay analysis. So we really dive into the LBO in a later video. So these 4 tabs are related to the valuation of the target. And we need that to come up with sort of a football field, meaning a range of valuations for the target, so that the board, together with its advisors, can come up with a sensible range to offer the target, which can make sense, but you still need enough upside from the synergies, for instance, to be able to benefit from that down the line. All of this ultimately flows into the merger analysis. You don't actually need all of this valuation analysis if you already have an offer price in mind. Without all of that, that works too. And then you model out the merger itself to understand, is it accretive? Does it help my earnings per share to go up? Or is it dilutive? Does it make them go down compared to a standalone basis? Very important for a merger is also the way you finance it. And for this, you can of course use debt, equity, or cash that you have on the balance sheet. But if you use too much debt, you might get into the risk of losing your investment grade rating if you had a good rating, meaning that after the transaction, your interest costs will skyrocket because suddenly you're considered risky from a debt perspective. That's why bankers often include a rating analysis as well. And this is, by the way, something no one out there teaches you. And I'll dive into this in detail in a later video. And yes, in the very end, all of this comes together in some sort of a takeaway. You need to come up with a suggestion for the board as investment bankers. A DCF, trading comps, precedent transactions, and an LBO, they state what the company is worth or what a sponsor is able to buy in the case of an LBO. While a merger model and rating analysis, they show what happens at the price you picked to offer to the target, either from an accretion dilution point of view or from a rating point of view. And the operating model that we built, it feeds into all of these other valuation and merger related models, meaning that needs to have a solid foundation. And if that's wrong, then everything else will be wrong as well. Before creating all of these models, you need to have a few conventions that are defined up front. For example, column H is for year 26. So in the other tabs, column H is also 26. So you can easily audit these things. Same goes for how do you show negative numbers with a parenthesis or not. Do you have a decimal for normal absolute figures? Do you have a decimal for percentages? Do you show percentages as italic or not? And all of this just makes auditing much easier and the model visually much cleaner. So that's the map: comps, precedents, DCF, LBO, merger model, rating analysis, each answering a different piece of what Danone is worth to Nestlé. And next we start where every model starts, and that's getting real financials into the sheet. And this step is called spreading. The Excel file to follow along is linked below, and so is a free AI workflow for this stage. Make sure to hit the subscribe button to see how we spread the financials of Nestlé and Danone. See you in the next video.